If we talk about the strongest oil and gas stock in the Thai market and, a compelling dividend play, PTTEP has to be number one. In an era where global energy prices are, well, volatile and geopolitical uncertainty is high, did PTTEP manage to generate target earnings in its Q3 2025 results? And will the critical factor of proved petroleum reserves be the key to driving its long-term valuation? Today, we are taking a deep dive into PTTEP.
Welcome. Our mission today really is to move beyond just the immediate headlines. We want to thoroughly evaluate whether PTTEP's fundamentals, operations, finance, and that aggressive future growth strategy can genuinely sustain its reputation as a safe haven asset linked to oil prices.
Sounds good. Where are we getting our info from?
We've stacked up the latest data. The Q3 2025 financial filings are key, obviously, plus operational forecasts directly from management and some deep analysis from multiple securities firms. So looking at DAO, Krung's Re, InnovSX, and LH Securities.
Okay, quite a range.
Yeah, so we're going to help you, the listener, understand the true stability, or maybe the lack thereof, underpinning this energy giant.
All right, let's unpack this immediately. Starting with that Q3 2025 financial snapshot. The headline numbers were, perhaps not what the market had hoped for.
No, probably not.
The reported net profit for Q3 2025 came in at 12,695.087 million baht. That translates to an earnings per share, or EPS, of 3.19 baht. Now, that sounds like a big number in isolation, but how does it actually stack up?
Well, context is everything here, and this is really where the market's concern came from. When you contrast that Q3 2025 figure with the same quarter last year, Q3 2024, well, net profit then hit 17,864.571 million baht.
Okay.
So that 12.7 billion baht result we just saw, it represents a pretty significant 23% reduction year on year.
23%, wow.
Yeah, and for a stock often prized for its stability, its reliable performance, a drop of that magnitude definitely raised some immediate red flags among investors.
But it wasn't just the year-on-year comparison, right? Looking quarter on quarter, the profit was also down 6%.
That's correct.
And maybe most critically for market sentiment, it missed the consensus estimates from analysts by quite a bit, actually 9% to 10%. So the immediate question is, if their operational volumes, which I know we'll get into shortly, were actually quite strong, why did the profit miss so badly? What pulled that net income figure down?
Right, and this is the crucial nuance that, a shallow reading of the report might miss. The primary drag on the earnings, despite solid sales volume, was actually higher than anticipated tax expenses.
Taxes. Okay.
Yeah. When analysts model expected profit, they have assumptions built in for tax rates, timing, all that stuff. In the exploration and production sector, these, let's call them surprises, often come from things like deferred tax adjustments or maybe the timing of realizing tax holidays on new projects like that MTJDA 18 block.
Right, the new acquisition.
Exactly. Or even changes in how specific capital expenditure is treated for immediate tax purposes in different countries they operate in. It gets complicated.
So if I'm an investor listening to this, I need to figure out if this 23% drop is like a structural problem, meaning lower long-term profitability is coming, or if it's just a timing issue, something related to accounting and taxes.
And the sources strongly suggest it's the latter. It looks like a non-operational factor, which helps explain why, analysts didn't completely panic and immediately downgrade the stock across the board.
Okay, that makes sense. So the operational side, the actual pumping of oil and gas, was okay.
Exactly. The operational cash flow, their ability to physically produce and sell oil and gas, was robust.
Yeah.
The issue was really that final line item deduction for taxes, which just came in larger than forecast. So the market seems to have digested this more as an accounting timing issue rather than some fundamental flaw in their ability to extract energy efficiently.
Okay. Let's zoom out a bit then from just the single quarter. Let's assess the overall 9-month year-to-date performance for 2025. That's 9M 2025. How does the cumulative picture look there?
Well, the 9-month view definitely confirms the company's sheer scale. Total revenue reached 220,503 million baht. That translates to a massive $6,659 million day. Big numbers. Huge. And the cumulative net profit for those 9 months stood at 42,761 million baht, or about $12,088 million USD. This gives us a much clearer picture of their likely full-year trajectory.
And how far along does that 9M profit get them toward the full year targets? The ones set by the research houses we're tracking.
Right. So that 42.7 billion baht profit, it represents roughly 67.6% to maybe 72% of the full year 2025 profit forecasts from those analysts.
67 to 72%, with 3 quarters gone.
Exactly. Now, given that Q3 missed expectations, this coverage percentage is maybe slightly lower than ideal for this point in the year. It strongly suggests that PTT2D really needs a Q4 performance that significantly outstrips Q3 to hit those analyst consensus targets.
So the pressure is absolutely on for the final quarter, both for volume realization and, I guess, price stability.
Definitely. Q4 needs to deliver.
Okay, that sets the stage nicely for the operational discussion later. But let's shift first to the core valuation metrics. Because this is where PTTT usually shines for value investors, right? Regardless of a single quarter's tax anomaly.
Absolutely. And this is where the story gets, well, profoundly interesting for potential investors. Despite that short-term earnings volatility, PTTEP appears fundamentally deeply undervalued. LH Securities in particular highlights several compelling figures for their 2025-2026 forecasts that just scream value.
Okay, let's start with the classic. Price to earnings, the PE ratio. What's that looking like?
The forecast PE ratio for 2025 sits at an exceptionally attractive 6.2 times.
6.2x, that is low.
It really is. To put that into perspective, the PE ratio for the broader Thai stock market, or even many integrated global energy majors, is often significantly higher. A PE of 6.2x implies, well, investors expect maybe moderate growth, but more importantly, it's just a very fast payback period on your investment.
But the real kicker, as you said, is often the price to book value, or PBV. This is the metric many investors look to for asset stability, right?
Exactly. And the stock is trading at a, frankly, palpable discount to its book value. The projected 2025 PBV is only 0.80 times.
0.8.
0.8. It's a classic indicator of deep value. It basically means if you bought PTTT today, you would theoretically be paying only 80 cents for every dollar of audited assets the company owns. And those assets are things like proved petroleum reserves, major infrastructure, production platforms, tangible stuff.
That 0.80x PBV is pretty staggering for a company with this kind of operational track record. And LH Securities thinks this discount shouldn't exist.
They don't. LH Securities estimates that a more rational, let's say target PBV for a stable dividend-paying energy major like PTTEP should be closer to 1 times for 2026.
Back to book value.
Exactly, which implies an inherent upside of about 25% just from the valuation ratio normalizing, assuming the book value itself holds steady. That signals immense fundamental resilience.
Okay, low PE, very low PBV. What about capital efficiency? Are they actually good stewards of this massive asset base they have?
The answer seems to be yes. The projected return on equity, or ROE, for 2025 stands at 13.3%.
13.3%.
Which is a robust and healthy number. It reflects that management is actually highly efficient at converting shareholder capital into profit, even during this current environment of, softer pricing and those increased taxes we saw.
So those core valuation metrics, the PBV and ROE especially, they really form the backbone of that safe haven argument, don't they?
They absolutely do.
That makes perfect sense. So, okay, the short-term earnings miss looks like it was due to a technical tax issue, but the long-term value indicators, PE, PBV, and ROE, are flashing bright green, suggesting the stock is fundamentally cheap. Let's look under the hood now at the engine driving those numbers. Let's move into section 2. Revenue drivers, volume, price, and cost.
Absolutely. And it feels like the financial miss might have completely overshadowed what was actually a genuinely strong operational story, particularly concerning volume growth, which, as you know, is critical for long-term reserve replacement in this industry.
So tell us about the Q3 volume performance. How did they do?
Q3 2025 average sales volume was remarkably robust. It hit 510,000 barrels of oil equivalent per day, or BOED.
510K BOED.
Yeah, and that marked an 8% increase year on year. Furthermore, the 9-month average volume for 2025 was nearly 500,000 BOED, 499,925 BOED to be exact. That represents an overall 3% increase over the same period in 2024.
8% year-on-year growth in production volume is significant, especially in the mature E&P sector where, just maintaining stable production often requires massive CapEx just to fight natural decline rates. What were the key growth levers here?
There were 2 immediate and, I think, quite strategic drivers. First, the successful acquisition of that 50% stake in the MTJDA A18 block, that's the Thailand-Malaysia Joint Development Area, which was finalized back in July 2025. This provided an immediate and material volume uplift. It's projected to add about 10,000 BOED right off the bat. Acquisitions like that, the ones that are immediately accretive to production, are fantastic for bridging any short-term capacity gaps.
Makes sense. And the second driver relates to one of their most significant domestic assets, right? The G161 project.
That's the flagship Erawan field in Thailand. What we're seeing there is the continued successful production ramp-up. Production has been steadily increasing since March 2024, and it's now hitting the key milestone of 800 million cubic feet per day, MMCFD.
800 million? That's a big number for Erawan.
It is. Achieving that production level at a field as technically complex as Erawan is a major operational achievement. And it's a massive de-risking event for PTTEP's domestic portfolio. It helps ensure long-term gas supply stability for Thailand itself.
So M&A provided the immediate punch, and the successful development of Erawan provided the long-term domestic backbone.
Okay, now given that 9M profit was only at, 72% of the target, the pressure is definitely on Q4. What is management forecasting for volume in the final quarter? Are they expecting another jump?
They are guiding for a significant volume spike, actually. Management targets volumes to reach somewhere between 550 and 570,000 BOED in Q4 2025.
550 to 570K, that's a big jump from Q3's 510K. It is ambitious, and it relies on two main things. First, getting the full quarter contribution from that newly acquired A18 stake we just mentioned. And second, the cyclical effect of increased oil loading schedules from their international projects, particularly in the Middle East and Africa. Those loadings can sometimes bunch up towards year-end.
Okay, so that 550K to 570K BOED range, it really shows how critical that A18 acquisition is for immediate delivery. But, relying on a large Q4 volume jump always introduces execution risk, doesn't it? Especially when the overall annual targets depend so heavily on it.
Absolutely. The market will be watching that Q4 report very closely to ensure that the operational execution, the full integration of A18, the timely loading of international crude, actually materializes to deliver those volume figures. No guarantees until it happens.
Right. Okay, volume sounds fantastic, a really strong point. But as we saw with the Q3 miss, the price side of the revenue equation acted as a serious headwind. Let's talk about the average selling price, ASP, and its direct link to global crude oil trends.
Yeah, the ASP pressure was pretty much unavoidable. It reflected the global energy market softness we saw during Q3. The Q3 2025 average selling price landed somewhere around $43.20 to $43.98 per BOE.
Low $40.
Yeah. And this figure represents a drop of about 8% year-on-year and roughly 2% quarter-on-quarter. That price decline was the direct factor that counteracted those excellent volume gains we just discussed and ultimately drove the lower top-line revenue figure.
What crude oil price assumption is PTTEP's management using in their own forward-looking models? What are they basing their plans on?
Their estimate for the average Dubai crude oil price, that's their key benchmark for the full year 2025, sits in the range of $65 to $75 per barrel.
$65 to $75 Dubai.
Okay. So this forecast suggests they anticipate a generally managed supply environment, where output control by groups like OPEC Plus helps prevent prices from completely crashing, but where global demand concerns perhaps keep the top price cap below those extreme highs we've seen in the past.
And here's where the stability argument really differentiates PTTEP from, say, pure-play crude oil producers. Their heavy exposure to natural gas, right?
Exactly. That gas stability is really the company's structural insulator against oil price swings. Gas prices are forecasted to remain highly stable, pegged at approximately 5.8 cents per million British thermal units, for Q3 2025. And they're expected to hold pretty steady throughout the year.
So stable gas prices help.
Immensely. Because a substantial portion of their revenue comes from long-term gas sales contracts. Often these are delinked, or at least less immediately sensitive to daily oil price fluctuations. This provides that reliable baseline cash flow, the kind that supports the dividend payout.
It provides a floor for the revenue that pure oil producers simply don't have, which helps explain the high expected EBITDA margin maybe. Speaking of which, let's look at costs. What was the unit cost and how are margins holding up overall?
The unit cost in Q3 2025 was around $31.50 per BOE, so it's remaining above that sort of $30 mark.
Wait a second. If their unit cost is $31.50 per BOE, and their average selling price was soft, you said low $43 per BOE, that gross margin seems pretty thin on paper. How on earth are they still forecasting an EBITDA margin consistent with that long-term target of 70% to 75%? That margin is phenomenal.
That's a really great question, and it illustrates why just looking at the average selling price for the combined portfolio can sometimes be misleading. that incredibly high 75% EBITDA margin is achieved because the gas contracts, remember, they operate under different pricing structures and terms than the crude oil sales.
Right.
Those gas fields often have exceptionally low lifting costs relative to their sales price. The high overall unit cost might be skewed by more complex, maybe higher cost international production sites, but the bulk of their reliable cash flow comes from mature, highly efficient gas fields. That allows them to keep that overall EBITDA margin incredibly high, making them, frankly, a premium cost producer in the E&P space globally.
Understood. So the combination of stable gas revenue and high production efficiency in their core assets creates this massive cash flow buffer, and that shields them somewhat from the volatility we see in the ASP.
Okay, let's pivot now to the crucial element of long-term stability. Section 3, looking at proved reserves and future growth.
Right, because the ability of an E&P company to actually replace the resources it extracts is arguably the single most important metric for long-term valuation. And PTTEP has been quite aggressive on this front, relying both on immediate M&A and a large planned CapEx budget going forward.
We already mentioned the 2 M&A successes that added immediate reserves and production.
Yeah.
Let's just reiterate their strategic importance quickly.
First, that MTJDA A18 stake. Strategically vital. It not only added production volume, but it significantly contributes to Thailand's own energy security. It's supplying 300 MMSCFD, which is about 6% of the country's entire national gas demand.
6% from one deal.
Yeah. And when a deal stabilizes national supply like that, it tends to gain political and economic backing, which further enhances its stability profile. Good point.
Yeah.
And the second major win was further afield in Algeria.
That's right, the acquisition of a 22.1% indirect interest in the Algeria Tuat project. Important for geographic diversification. This project is already producing. It has a 435 MMSCFD capacity. It's expected to immediately contribute about 6,000 to 7,000 BOED to PTTEP's international output.
Okay.
And perhaps more importantly, add an estimated $20 million to $30 million in core profit annually. These are high-quality assets already operating under existing secure contracts.
Okay, so those deals provide an immediate boost. Now for the long view. What is the scale of the commitment PTTEP is making to ensure growth continues beyond these recent acquisitions?
Well, a 5-year growth pipeline covering 2025-2029 is frankly enormous. The total investment budget for this period is set at $33.587 billion.
$33.5 billion.
It's a colossal figure. And what's noteworthy is that this budget is actually up 3% from the previous 5-year plan. That signals an accelerated commitment to capital deployment, even in this period of price uncertainty. Of that total, $21.249 billion is earmarked specifically for capital expenditure, or CapEx.
Okay, $33.5 billion in funding commitments for the next 5 years. That is a massive endorsement of their growth strategy for management. What kind of growth are they expecting to get from that level of investment?
They're forecasting a compound annual growth rate, or CAGR, for a sales volume of about 3.4% over those 5 years.
3.4% CAGR.
Yeah. Achieving over 3% CAGR in the E&P space is ambitious, make no mistake. It relies entirely on executing those major projects on time and on budget.
Where is that growth going to come from geographically? Are they doubling down domestically or looking elsewhere?
The strategy is explicit. It's diversification. The share of international production is forecasted to increase from its current level of around 32% to a significant 43% within the next 5 years.
From 32% to 43%. That's a big shift.
It is. And it's a deliberate strategic maneuver to de-risk the portfolio. How? By offsetting the expected natural decline from their mature existing domestic Thai projects, it moves them much closer to being a truly global energy player, less reliant on just the Gulf of Thailand.
Which specific final investment decisions or FIDs are management prioritizing to actually hit that 43% international target? Where are the big bets being placed?
They seem to be focusing on key capacity building projects internationally. We're looking at the acceleration of Phase 2 of the Algeria Hassi Bir Riquez project. There's the Abu Dhabi Offshore 2 project in the Wased area that's a major new international gas hub potential, and several new Malaysian greenfield projects where significant discoveries have already been made. These FIDs are what will convert those resource estimates into actual proved reserves, which is, the ultimate measure of long-term stability for the company.
Okay, this all sounds like a pretty well-managed pipeline of growth, diversifying away from Thailand, until we hit one specific and potentially quite large issue: geopolitical risk associated with complex overseas projects. We have to discuss the Mozambique LNG project.
Yes, unfortunately we do. This is perhaps the single biggest external risk factor facing PTTEP right now. PTTEP holds an 8.5% stake in the Mozambique Area 1 LNG project. It's a substantial investment, valued at approximately $1 billion, or over 32 billion baht.
$1 billion. And what exactly is the nature of the risk there? Is it technical, financial?
It's primarily security. The project is severely stalled due to chronic instability in the Cabo Delgado region of Mozambique. The area has been afflicted by prolonged insurgencies and attacks from non-state armed groups for years now. This forced project delays and, critically, led PTTEP to have to close its local office and remove personnel some time ago.
So you have $1 billion essentially tied up in an asset that cannot currently produce or even be safely worked on.
That's the situation. It's extremely challenging.
That level of risk must require external, even governmental intervention, which the sources suggest has happened.
That's correct. The situation is serious enough that the Thai government, particularly the Ministry of Foreign Affairs, has been actively negotiating with Mozambique's government to try and ensure security guarantees for PTTEP's investment. We've seen negotiations focusing on employing external security forces, potentially like those from Rwanda, to secure the site and equipment just so that development can hopefully restart safely.
Wow. The fact that governments are involved at that level really highlights the magnitude of this particular hurdle. The delay must be affecting cash flow projections, and it's tying up significant capital that can't be immediately redeployed elsewhere.
Absolutely. It serves as a stark and very high-cost reminder that while geographic diversification is the goal for E&P companies, it definitely introduces security and political risks that domestic operations, even with their own production declines, generally don't carry to the same extent.
Precisely. It's that constant trade-off in the E&P sector, isn't it? You have to take on risk to find and replace large reserves. But those risks aren't just geological anymore, they are very much security and political risks.
Couldn't agree more.
Okay, let's shift gears a bit. From geopolitical risk to the critical long-term sustainability strategy, PTTEP has made what looks like a landmark commitment to carbon capture and storage, or CCS. This directly addresses the environmental and social governance, the ESG risk, that the whole energy sector is facing.
Yes, and this is their major strategic move into the energy transition, and it's massive. PTTEP made the final investment decision, the FID, on Thailand's very first carbon capture and storage project. It's going to be located at the Arthit gas field.
Thailand's first CCS project.
That's right. And this isn't just, corporate greenwashing or a press release. It's a tangible multi-million-dollar commitment to build and operate this facility.
What makes the Arthit CCS project so important, both for PTTEP itself and for Thailand as a whole?
Well, the project aims to capture and securely store up to 1 million tons of CO2 per year. Injection is expected to start sometime in 2028. And management has been very clear that this process will be integrated without disrupting the ongoing gas production from Arthit.
So capture the CO2 without hurting the gas output.
Exactly. For PTTEP, it helps secure their license to operate in the long term by reducing the carbon intensity of their primary product, natural gas. For Thailand, this project is really a cornerstone. It positions PTTEP to potentially lead the development of a whole eastern Thailand CCS hub, which is seen as critical for meeting the country's ambitious net zero target by 2050.
That's a fascinating strategic point. This commitment could potentially re-rate the company in the eyes of investors, right? Moving it from being just a simple commodity producer towards being a key infrastructure and technology provider for the nation's decarbonization goals. That could change the whole investment narrative over time.
It fundamentally could. When, or perhaps if, the market starts pricing in this kind of leadership and infrastructure capacity, the valuation multiples could begin to shift, moving beyond just that simple linkage to the daily price of Dubai crude. It adds an entirely new dimension.
Very interesting. Okay, let's move now to Section 4, the analyst view and the consensus target price. How is the professional investment community actually viewing this mix of Q3 disappointment, strong volume growth, future investment, and now this ESG angle?
Well, despite that Q3 earnings miss, which, remember, seemed driven by the tax expense, the overall analyst sentiment remains overwhelmingly positive. The consensus view is consistently buy or outperform.
So they're looking past the Q3 blip.
It seems so. They appear to be focusing more on the anticipated strong Q4 volume recovery, and more importantly, the long-term stability provided by that high dividend yield and the funded 5-year investment pipeline we discussed. The tax hit is largely being viewed as sort of a one-off noise factor in the bigger picture.
Okay. But we noted earlier that the target prices themselves show quite a surprising level of divergence. What are the key ranges we're seeing, and why are they so different if the overall sentiment is positive?
That divergence is really interesting, and it confirms just how sensitive the stock's valuation is to long-term assumptions. Specifically, the assumed long-term price of oil. The targets we've seen span from around 130 baht all the way up to 169 baht.
130 up to 169. That's a wide range. Let's start with the more conservative end of that range.
Okay, Krungsri Securities offers a target price of 134 baht. Their reasoning emphasizes the stable cash flow profile, the assurance of a continuous high dividend, and their view that OPEC Plus will likely keep supply disciplined, which should minimize extreme price volatility downwards. DAO Securities is slightly lower at 130 baht for their 2025 estimate. They use a discounted cash flow, or DCF model, and their thesis really hinges heavily on management successfully delivering that large Q4 volume bounce back we talked about earlier.
Okay, so 130, 134 range there. Then we see the targets jump significantly higher.
Right. Moving into the mid-range, InvestX projects 147 baht. They also use a DCF model, but crucially, they're assuming a long-term Brent crude oil price of $64 per barrel in their calculation. And they really stress the company's ultra-strong balance sheet, specifically highlighting that net debt-to-equity ratio of just 0.1 times as the key factor supporting this higher valuation.
0.1 XDE is basically no debt.
Essentially zero net debt relative to equity, yes. It's incredibly strong.
And then LH Securities is the most bullish. They're the ones suggesting 169 baht.
That's right. LH Securities sets the peak target that we saw at 169 baht.
Right.
They also base it on a DCF model, but they use a more optimistic long-term oil price assumption of $72 per barrel. And they specifically cite the high expected dividend yield, which is obviously a key driver for investor demand, as justifying this premium valuation.
Okay, let me just clarify this. The difference between InvestX's $64 to a barrel assumption and LH Securities' $72 per barrel assumption. That's only an $8 difference in the projected long-term oil price rate.
Correct, just $8 per barrel.
Yet that relatively small delta translates directly into a 22 baht difference in the stock's target price from 147 to 169. For the listener, why is the DCF model so incredibly sensitive to what seems like a relatively small change in that long-term oil price input?
Yeah, this is the nature of discounted cash flow models, especially in the E&P sector. DCF tries to value an asset based on the present value of all the future cash flows expected from those proved reserves.
Yeah.
And these cash flows can stretch out for decades.
Right.
The long-term oil price assumption is arguably the single most important variable input because it gets multiplied across every single barrel of oil and gas PTTEP expects to extract over the next, say, 20 to 30 years. So even a seemingly small $8 difference, when you compound it and project it over all those decades of production, it drastically changes the calculated net present value of the entire company. That explains that massive spread in target prices based on slightly different outlooks.
Got it. So if you, the listener, believe oil is structurally moving back toward the $70, then the upside in PTTEP could be substantial according to these models. If you believe it stays closer to the mid-$60, the upside is more moderate, but still looks solid based on current prices.
That's a pretty good summary. The core underlying value seems to be there, but the target price volatility really just reflects the inherent external oil price volatility.
Okay. That brings us directly to the stability factor that acts as such a magnet for many investors. The dividends. Let's talk about Section 5. Dividend attractiveness and the financial stability supporting it.
Right, the dividend is key to the PTTEP story. Their official policy targets a payout of not less than 30% of net profit after tax annually. That's their stated minimum commitment.
30% minimum.
Yes. However, in practice, they've historically been far more generous. Based on the strong 9M data we have so far, the payout ratio is actually estimated to be around 56% for the full year 2025.
56%. That's nearly double the official minimum policy.
Exactly. They're returning a lot more cash than they strictly have to by policy.
And we know an interim dividend was already paid 4.0 baht per share for the first 6 months of 2025, which provides that immediate income stream to shareholders. What is the projected yield looking like for the full year based on current share prices?
Analysts are estimating a total yield for 2025 generally falling in the highly compelling 7% to 8.1% range.
7 to 8% yield.
This exceptionally high and historically reliable yield is the primary reason the stock maintains that safe haven reputation, particularly for income-focused portfolios.
Right.
Especially when you benchmark it against general market indices or even government bond yields right now.
Okay, but a high yield is only truly safe if the underlying financial structure of the company can withstand inevitable downturns or, oil price shocks. Does PTTP possess the financial stability to actually maintain a 7%, 8% yield, even if, say, the Q3 profit dip scenario were to continue for a while?
Absolutely. And this goes right back to the balance sheet strength that InnovestX highlighted. The company's remarkably low net debt-to-equity ratio of 0.1x. That's basically a fortress-like financial position.
0.1 DE again.
It means the company is barely leveraged at all. This massive financial cushion provides them with the capacity to fund that huge $33.5 billion CapEx plan we talked about and maintain those high dividend payouts, even during volatile periods when cash flows might temporarily drop. They are not dependent on high oil prices just to service debt or pay their investors.
So that low leverage fundamentally de-risks the dividend payout. It's the ultimate validation of their capacity to keep paying, isn't it?
It really is. It's the core reason why many investors treat this stock as fundamentally different from some of the more highly leveraged global energy peers. The financial risk is just much lower.
Okay. We've covered the financial performance, the operational engine, the long-term growth pipeline, the analyst views, and the dividend story. Let's try and bring it all together now for our final verdict. Is PTTTP truly a safe haven asset linked to oil prices? What's the takeaway?
All right, to summarize the fundamental picture, Q3 earnings were disappointing on the surface, yes, but it seems that was largely due to non-operational noise specifically, the higher tax expense, and that temporary dip in the average selling price.
But the core operations were strong.
Exactly. The underlying operational heart looks robust. It was driven by strong, successful M&A activity getting A18 and Algeria 2 out online, and also that successful domestic production ramp-up at the Erwan field. Operationally, they delivered.
And the future looks funded and increasingly diversified internationally.
Correct. The company has committed to a clear, very large, $33.5 billion 5-year investment pipeline that's designed to secure reserve stability and strategically increase foreign production up to 43%, thereby diversifying their geographic risk away from just Thailand. Now, despite the clear hurdle posed by that stalled Mozambique project, the balance sheet, as we just discussed, remains pristine.
So when you couple all that with the low price-to-book value of 0.80 times and that high dividend yield in the 7% to 8.1% range, supported by near-zero leverage, what is the final assessment? Safe haven or not?
Like PTTEP exhibits deep fundamental resilience. Is it a traditional safe haven like gold or government bonds? No, of course not. Its cash flow is still inherently linked to volatile oil and gas prices. However, it is an exceptionally compelling value play within the energy sector. It possesses structural resilience primarily through its stable gas revenue base and that fortress balance sheet that partially mitigates the worst effects of crude oil price volatility.
So resilient value play, maybe not a classic safe haven.
Precisely. Its proven ability to generate high returns on equity and sustain those huge dividend payouts makes it arguably the most stable vehicle for investors wanting exposure to energy prices in the Thai market, and perhaps the region. So yes, it looks highly attractive, especially in volatile times like these.
This has been an incredibly detailed look at PTTEP's fundamentals, its operational strengths, and the strategic path management has laid out for the next 5 years. Before we wrap up, we want to leave you, our listeners, with one final thought to consider.
Yeah, just something to mull over. Given the company's aggressive investment and that final investment decision on the carbon capture and storage project at the Arthit gas field, which is a major move directly supporting Thailand's 2050 net zero target, how quickly will the market begin to properly incorporate this leadership in energy transition and ESG factors into its long-term valuation model for PTTEP?
Will investors eventually see PTTEP as more than just an oil and gas stock?
Exactly. Could it potentially command a higher valuation multiple in the future? One that moves beyond just the immediate, sometimes daily linkage to crude oil price fluctuations. That feels like the fundamental re-rating question that could define its true value over the next decade. Something to watch.
How was our in-depth look at PTTEP? We hope this information helps you decide whether this energy stock is right for your portfolio. If you have any questions or perhaps would like us to analyze a specific stock in a future deep dive, please do let us know. Finally, don't forget to like, share, and subscribe to support our team. Thank you.